Buying a home is more than just a transaction. It's a journey. And for many, it can feel overwhelming, confusing, and even a little scary. But hey, you're not alone. Welcome to From Rents to Roots, Home Ownership with Work Hard Mortgage, where we share real stories from real people who have navigated the home buying process. In each episode, we sit down with first-time homebuyers, industry experts, and real estate professionals to talk about the challenges, surprises, and lessons they've learned along the way. If you're dreaming of owning a home but don't know where to start, you're in the right place. Let's dive in. Welcome to From Rents to Roots, where we get to talk to people that know a little bit about real estate. And today we got two guests here. Do you want to introduce yourselves? And then we'll dive into why you guys are here and what's going on here. So go ahead and I'll let you introduce yourself first, and then we'll go over here.
Yeah. First off, thanks for having us. My name is Mike Lode, and I specialize in helping aspiring real estate investors identify ideal properties, use systems so that they can self-manage their properties and qualify for the tax savings that come from accelerated depreciation and the One Big Beautiful Bill. And my goal is to turn all of my clients into millionaires. So my goal is that to help them retire with $1 million in passive income a year from their real estate portfolios. And we have a system to help people do that over a period of as quick as 15 years to 20, 30, whatever their retirement horizon is.
Okay, awesome. Thank you. Go ahead.
Yep, and I'm Scott Clark. I do the same thing as Michael. We do it together, we work together. I love real estate investing. I bought my first property at age 23, bought another one since, and plan on continuing to keep buying. I think it's the best way to build wealth. So
yeah, I always tell people it's not get rich quick, it's get rich slowly, but it does happen, right? So it's not an immediate kind of thing, but it does happen, right?
It's not flashy, but it's dependable.
It's not. That's exactly it. And I think, frankly, we live in an age with crypto and different things like that, and I won't discount that people are actually making money off some of these things, right? But they seem a little more in the line of gambling at times, where it's like, hey, I don't actually know this is going to work, and great, hey, it worked, and not. Whereas real estate seems a little more tried and true. And again, it's not quick, right? It's not something that happens right away, but it does happen, right, over time. So talk to us. So what is the plan? Tell me what you guys are doing and stuff like that. Why is yours unique? Well, go ahead and introduce the audience to what you guys are doing.
Yeah, of course. First, I just want to echo what you said, that why it's such a good way of investing. And you're talking about all the other ways feel a little bit like speculation and gambling. Sure. And the reason that I like real estate investing so much more than other methods is it's one of the only investments where you can decide what your rate of return is going to be by deciding how much leverage you want to utilize in the properties that you buy. If I want to own $100,000 of stock, I have to put in $100,000.
Correct, yeah.
Whereas if I want to own $100,000 of real estate, I only have to put in $20,000.
Sure.
And so the exact same investment gets me 5 times the returns. And so that ability to leverage your money allows you to, if you're being conservative about real estate investing, at a minimum, you should be doubling the returns that you would get in a balanced portfolio in the stock market. Some people are a little more aggressive, and they can get triple or even 4 times the returns in real estate. A lot of people know who Barbara Corcoran is.
Sure.
From Shark Tank.
Sure, yeah.
She likes investing in small business owners. She's very passionate about helping entrepreneurs. What most viewers don't know is that her fortune comes from real estate. She was a real estate agent in New York City, started her career in her 30s, and today she's worth over $100 million. And that fortune was all built by investing her real estate commissions in buying real estate herself. Mm-hmm. And anyway, so there's very few ways that you can build a $100 million fortune in such a short span of time as she had, and real estate's how she did it.
And a lot of people may say, hey, yeah, okay, I can see that a lot of people have made money in the past, especially pre-2020, right? Mm-hmm. When housing prices were going up and stuff like that. It seems like for the last several years, we've been a little more stagnant. Is real estate still the investment that we think it is, right? Why invest in real estate now where, especially you mentioned stock market, stuff like that, hey, just throw it in an index fund. It's done pretty well over the last 6 years, right? Compared to real estate. So why is real estate still a good investment for people?
Yeah, so one of the main reasons why real estate's so great is it's one of the only investments that's not a fad. Food, healthcare, housing. Those are the only 3 businesses you can choose to get into that aren't a fad and won't go out of style.
Sure.
People always need a place to live. And when people say, is real estate going to keep going up? And the answer is yes. So the majority of inflation of appreciation we see in real estate is from land. And specifically where we're located right now in Utah, we have a shortage of land. We're surrounded by mountains, and there's not much buildable land. And so the appreciation of land as it becomes scarcer, supply and demand, right?
Yeah.
But let's say land stops going up in value somehow. Let's say the human population across the world all of a sudden starts declining and there's a surplus of land. The main thing behind the appreciation of real estate is inflation. As long as the cost of materials continues to go up and the cost of labor continues to go up, the replacement cost of any existing structure continues to go up with inflation. So I ask people, do you think inflation is going to go backwards? Are we going to experience deflation? And everyone knows inflation's gotten worse, not better.
Sure.
And so over the last 100 years in America, we've experienced an average 3.3% annual inflation. And so you're at least looking at 3.3% appreciation on your real estate. However, in Utah, if you look at the last 40 years, our average appreciation statewide has been about 5% over the last 40 years. And you're like 5%, like a balanced real estate portfolio goes up over the last same span of time, like 7 to 8%. So it's twice as good to be in the stock market. Why would I invest in real estate?
Yeah.
This comes to the leverage. So in investment property, you have to put 20% down. That means you have 5 times leverage. So if you have $1 million to invest and you put it in the stock market, you're earning $70,000 to $80,000 a year with a balanced portfolio of 60% stocks and 40% bonds. If you're investing in $1 million in real estate and you're putting 20% down, you're able to buy $5 million of real estate. And if they go up the average appreciation over the last 40 years of 5%, you've got $5 million properties. Each one generates $50,000 of profit. That's $250,000. That's a 25% return compared to your 7 to 8% return. That's triple the stock market. And so you can control your rate of return with your level of risk. And the stock market, what's really driven the stock market the last few years has really been like the AI boom, and a lot of people are talking about how it's an AI bubble, and it's all speculation. There are no profits to AI yet. There's a lot of debt being incurred to build these data centers, and so people wonder how long can the stocks keep going up when all they're doing is accruing debt, and even if they owned their data centers, they still wouldn't be profitable. They don't have a profitable business plan.
Sure.
It's not a profitable model yet. Nobody knows how to turn it profitable, but nobody wants to be left behind, right?
Sure.
It's very reminiscent of the dot-com bubble. And that's a scary place to have all your money sitting. Whereas if the stock market, if it is a bubble and it bursts, people are still going to need a place to sleep.
Yeah.
And since the 2008 crash that we had in real estate, we've underbuilt everywhere in the US. We have a drastic shortage of housing. There's a lot of families that are doubled up in units because there's not enough supply. And so real estate is a very low risk, if you do it correctly, investment, and you can get outsized returns.
Okay.
So yes, I think real estate is a great place to be and will always be a great place to be.
Yeah.
The only place that it's not a great place to be is if you're in an area with a declining population. So you think about Detroit, like when we closed up our manufacturing facilities and started manufacturing cars overseas, and declining population. So there's a surplus of housing, drives down the price. In Utah, we are continually one of the top growing states in the nation, and our population growth is 5 times the national average. And even if every Utahn stopped having kids, we have 20 years of kids that are going to be aging into leaving their parents' home and needing to either rent or buy. And so we have a 20-year pent-up demand if everyone stopped having kids. But people aren't going to stop having kids. And so we have built-in 20 years of demand. And so 20 years, you can do a lot in 20 years in building wealth. Anyway.
And tell us a little more about your strategy. What have you found that works?
Yeah, so what makes what we do different is we're very focused on the tax benefits of real estate. And so if someone is a business owner and they're trying to find more ways to save on their taxes, or let's say they're a high-paid executive and they're wanting to save on their taxes, there's really no other way to save on your taxes that's better than real estate if you have another thing other than real estate or your business. And that's because of really the one big beautiful bill that was signed into law last July. If you remember when Donald Trump ran for president the first time and everyone asked him, release 7 years of tax returns, every presidential candidate does, and he was like, no, I'm good. And then someone at the IRS leaked his tax returns, and it showed that 3 of the last 7 years he had paid almost nothing in tax, like a few $100s as a billionaire. People are like, how is that possible? And I just follow the law. I don't write the laws, I follow the laws, and that makes me smart. And it's because real estate is his business. Real estate is how all the ultra wealthy families in America pay very little in taxes. And people might get upset about that, but at the end of the day, we have a shortage of housing. And so the question is, how does the government incentivize people with money to build housing for people who don't have money? And the answer is tax incentives. And so if I was putting my money in the stock market and able to get 7 to 8%, and I'm paying cash for my real estate, which a lot of wealthy people do. They don't like borrowing money, they just throw their money in. They're only earning 5%. So how do you make up that difference? And the answer is tax benefits. So if you're not leveraging, you can at least match the stock market because of the tax benefits. And here in Utah, for example, average home price is between $500,000 and $600,000. If you were to buy a $500,000 investment property and you were to do a cost segregation study, which allows you to accelerate about anywhere from 25 to 40% of the cost of the structure the year you buy the property because of the One Big Beautiful Bill. So the strategy has been around since the 80s. The Reagan administration introduced accelerated depreciation and cost segregation. But Donald Trump, knowing the benefits of it, he said, why should I have to take my tax savings over 5 years when you could just give them to me the year I buy the property? And so he passed something called 100% bonus depreciation in 2017 with the Tax Cuts and Jobs Act. But it was a temporary law that was phasing out. But he got it put into the One Big Beautiful Bill, which brought it back to 100% and made it permanent. So now the tax savings that would have taken, maybe 15 years of annual depreciation, you get the year you buy the property. So that average $500,000 rental property that you might get in Utah is going to generate between $100,000 and $125,000 tax deduction the year you buy the property. And you're still going to be able to generate between a $12,000 and a $15,000 deduction every year thereafter for the remaining 26 and a half years. And so you can't get a $125,000 tax deduction from buying another truck. And it's a really good tax strategy that isn't throwing your money away in an appreciating asset like a truck. You're putting it into an appreciating asset of real estate.
And do you focus on a certain type of real estate?
Yeah, definitely. Most people that own rental properties, it typically starts with they kept their first house. So they have their starter home, it's a fixer-upper, and then they want to move into a bigger, nicer house, and so they keep their smaller, older house. And so a lot of rentals, when people own just a handful, they're these 2-bedroom bungalows that were built in the 60s or the 70s. And what's interesting is most people who are small-time landlords or mom-and-pop landlords, they don't really know what their profit margins are. So our broker has been in real estate 50 years next year, started when he was 19. And he owns somewhere between 200 and 300 rentals. He's not even sure the exact number. What he does know is his profit and loss statements because he has an accountant and he gets quarterly profit and loss statements on all of his properties. And he noticed something curious about 20 years ago, and that was the single family properties. He was really, after expenses, he was only earning 2 to 3% profits. And most people aren't using a bookkeeper and they don't really know their profit and loss. But then he noticed he had bought a few townhomes. And 20 years ago, there weren't a lot of people building townhomes. So he only owned a couple of them. And he noticed that his profit margins on his new construction townhomes were over 20%. And so he started looking into why that was. And it turns out that when you have an aging single family property as a rental property, you have to set aside about 50% of your rents to cover taxes, insurance, routine maintenance, and then unexpected repairs, because everything wears out after 25 to 30 years. Sure. New roof, new furnace, new AC unit, new water heater, new pipes, new electrical, right? Everything. And it just constantly erodes your profits. But what he noticed is in his new construction townhomes, not only did he not have to worry about paying a landscaper to come and do the landscaping or worry about the external maintenance, but there were no repairs because it was new. And when he discovered this tax strategy, he realized that a lot of the investor clients that he had that had a handful of rentals that they had bought with him over the years, when he wanted to talk to them like, hey, I learned this cool tax strategy. If you buy property, you don't have to pay taxes, essentially. And they're like, that's great and all, but I can't handle more properties. My properties are a headache. I get calls all the time from these tenants. And so he realized we need to get you out of those properties and into new construction townhomes that don't require hardly any work at all. And then you can own more properties because it's not a headache. And so, yeah, it's our broker strategy that he's honed in on over 50 years, and it's very different from what most people do. but it's a lot more lucrative. It's a lot easier. And so that's what we do. We help our clients buy new construction townhomes. And the great thing about that is they're in the path of progress. And so instead of an averaging 5%, you actually average closer to 8% returns before leverage. So instead of 25% returns, you could potentially get up to 40% returns if you're putting just 20% down. And so basically over 7 years, you've more than doubled your equity in that property. And before it starts having problems, we help our clients sell their property and do a 1031 exchange into 2 properties. So every 7 years, you're organically doubling the number of rentals that you own. And so a one-time $100,000 investment to buy a single townhome after 7 years turns into 2. After another 7 years, turns into 4. And so a single $100,000 investment can get you up to 4 rental properties in just 15 years. And the tax benefits, if you were to start today and you were to do the cost segregation study and accelerated depreciation, those properties that you're buying are going to generate over $1 million in year 1 accelerated depreciation on all of those properties. And so a $100,000 investment can turn into over $1 million in tax deductions over 15 years. Even just by itself, that is a reason to invest in real estate. But then when you add in the profits, like if you just need tax savings, real estate's a great place to be. If you want to build generational wealth and retire with a reliable income and not have to worry about outliving your savings, real estate is a great place to be.
Talk to me. So you're saying your kind of strategy is buy a home for 7 years and stuff like that, and then you do it again. A lot of times the philosophy is, hey, let's buy and hold, right? Mm-hmm. Because once you sell, you have transactional costs, right? Mm-hmm. You have realtor fees, different things like that. Perhaps you have a good interest rate on that loan. You have to get a new loan, stuff like that. Are you saying the savings from the accelerated depreciation outweighs some of those things? Because there are real costs, right, go into play when you're trading out that home, right? Speak to that a little bit, because I would say that the normal thought process is, hey, keep it forever, essentially.
Yep.
Right? And so why is that not as good as what you're saying?
Yeah, so cash flow is what most people talk about when they talk about real estate. Cash flow is a bad thing until you're ready to retire. If you're a full-time real estate investor and you live off your rental properties, by all means, cash flow is what you should focus on.
Sure.
But every time you're spending your cash flow to pay your bills, you are slowing down your accumulation of wealth. And so most people do not have the willpower to save their cash flow. They spend it all. And most people, the only ways that they actually save money for retirement is either their 401k matching program, which they're losing out on 3 to 5% of their salary if they don't do at least the minimum matching with their employer. And the other way they save for retirement is in their house. It's a forced savings plan. If you don't pay your mortgage, you lose your house. Mm-hmm. Real estate is the exact same way. And so if you have a full-time job as a business owner or you work in corporate America, you don't need that cash flow. That cash flow is a monthly temptation to spend on things that you don't need. And so with our strategy, we help our clients figure out the smallest amount they need to put down to break even on the property so that their tenant is covering 100% of their costs, their interest, their mortgage, their taxes, their insurance, their HOA fees, all of their expenses. Because then they're maximizing their leverage and they're maximizing their returns. And it allows you to organically double your portfolio. If someone pays off their property, they're only earning 2 to 3%. Whereas if you're leveraging, you're earning 25 to 40%. And so the longer you hold a property, so let's use this example, right? Someone buys a property with 20 to 25% down. After 7 years, they're anywhere from 50 to 67% equity in that property from appreciation and their tenant paying down their mortgage. Okay. Your appreciation is the same regardless of how much debt you hold in that property and how much equity you have on that property. And so you might start out year 1 at 40% returns with close to 50% returns with 20% down, or 25% returns with a 25% down. And so the longer you hold that property, your internal rate of return is declining. So once you surpass 50% equity in a property, your rate of return drops below 10%. Once you get up to 67% equity, your internal rate of return drops to 7 or 8%, where that's what you can get in the stock market with a balanced portfolio. And so why would someone want to go through the headaches of being a landlord and fielding calls and going out and doing repairs to earn what they can earn easily in the stock market in a conservative portfolio? And so in order to maximize your returns, you need to keep re-leveraging your properties. And so as soon as you have enough equity to buy another property, you should. And so that's what people miss. It's the leverage piece. Anybody that bought their primary residence or a rental property prior to 2020 are sitting on average $250,000 plus in equity because of how crazy the run-up was in the pandemic. And you mentioned that things leveled off a little bit. That's because we exceeded the 3.3%, the average like 5% inflation in Utah appreciation over the last 40 years. We exceeded that during the pandemic. And so if you look at the average before the pandemic, we were right in line with that 5%, and then we spiked, and we're coming back to that line. And so we're very close to being back to that line where we should have been had the pandemic not happened. And so we've had this little lull over the last year and a half, 2 years in real estate, but that's going away.
Okay. And you mentioned people that have gotten into rentals either through keeping their previous home or maybe inheriting a home and have had that home for a little while. Mm-hmm. How do you suggest to that type of an investor, what would their plan be to getting into the townhome investing strategy?
Yeah, so it all depends on their situation, right? So let's say someone who's in their first home, they inherited it or they're ready to move up to their next home. I recommend sitting down with a real estate professional who can analyze whether those properties make good rentals or not. There's a lot of factors, looking at what average rent are for that type of property, looking at how recently have the systems been replaced. Prior to 1997, the plastic pipes we put in our walls, they degraded in the presence of chlorine. Why do you think that might be a problem, that your pipes degrade in the presence of chlorine?
There's chlorine in the water.
There's chlorine in the water.
Yeah.
The utility company puts chlorine in the water to stop algae from growing in the pipes.
Yeah.
It took 20 to 30 years for us to realize that we were putting pipes in our houses that degraded and became brittle. So they don't just shatter in the wall, but an earthquake happens or put any pressure underneath your sink, you're moving stuff around and you hit the pipe and they just shatter and they flood your house and they're a huge expense. Sure. And if someone has a property that was built prior to 1997 and they've never replaced the plumbing, they're just sitting on a disaster waiting to happen. And in order to replace your plumbing, you have to remove your drywall. It is a major renovation to replace the plumbing in a home. And so if you're in a home that has original plumbing, original electrical, original HVAC, original roof, or original sewer line, that's another thing that surprises people. Sewer lines, they used to build them out of clay, and tree roots break through to get to the water. And once your sewer line is broken, the only way to replace it, that's an expense that's on the homeowner. People don't know. The sewers themselves, that's the city. But your pipe underground to get to the sewers, that's on you. And so that can easily be a $20,000 repair that's just waiting for your tenant to say all of a sudden, sewer is backing up into the house and we don't know what's going on. Do a sewer scope and find out that your sewer line needs to be replaced. So looking at the age of the property and how recently things have been replaced, what's the liability of holding onto that property any longer? And so most of the time the answer is that it's not a good rental property. There are too many unknowns, ticking time bombs that can just destroy several years of revenue from your rental. And so sitting down with a professional that is familiar with real estate investing that can help you analyze whether the property makes sense to turn into a rental, or if it's no, get rid of that property, offload it on someone who wants a fixer-upper, and use that equity to buy one townhome, two townhomes. A lot of times people are sitting on a lot more equity than they realize. And it's, you could keep that as a rental and have this ticking time bomb, or you could sell it and take that equity and buy 2, 3, sometimes even 4 brand new townhomes that are zero headache and be earning $25,000 per property, $100,000 in appreciation versus maybe just $30,000 appreciation on that single family home. Yeah, that's my advice. Sit down with someone who specializes in real estate investing to see if your property makes sense to keep or not. But yeah.
And what about a first-time investor, somebody who's looking to get into their first property? Is this a good strategy for them to look into?
I think it's a great strategy for anybody that wants to invest in real estate. And so it all depends on the first-time investor. So it's really hard to start this strategy. You need about $100,000 in cash or equity. And anybody that is a primary homeowner that's owned their property since before 2020 is sitting on this huge pool of untapped potential in equity. And so I have a client that they refied their home during the pandemic to just under 3% rate. And they're like, we want to invest in real estate because we haven't saved enough for retirement and we're interested in the tax savings. And when they refied, they went from a 30-year mortgage to a 15-year mortgage. So they're like, we're 10 years away from paying off our house. And we've got a 3% rate, but we want to invest in real estate, but we don't have cash just sitting around. How can we do this? And so I connected them up with one of the lenders that we work with that specializes in special types of loans for investing in real estate, where you don't have to utilize your own income to qualify. The property qualifies based on its income generating potential. The property you want to buy is the income it's going to generate. That determines the size of your down payment. Anyway, so they sat down with this lender and he ran some numbers for them, even going from a 3% rate to a 6% interest rate. If they went from a 15-year mortgage to a 30-year mortgage, their monthly payment on housing would not increase at all, and they could pull out enough equity to buy 2 investment properties. And so it's all just a matter of how you look at it, right? Because that equity sitting there wasn't hardly earning them any returns, right? They were averaging 3% returns on that money that's just sitting there. And by tapping that equity without increasing their monthly expenses, they were able to find the way to buy 2 investment properties that are building them wealth that they need to catch up for their retirement savings. And so it all depends on the person and their situation. When they're a first-time investor, where can you get the money to make it possible? And people don't think of their primary residence. I'd say Dave Ramsey's really hurt people's thinking on that, because he talks about debt being bad, which I agree. But real estate debt is a good thing. If you can pay the bank 6% and you can earn 25%, you want as much debt as you can get.
And so talk to the viewers here about some of the risks of that, because they say, okay, hey, sure, yeah, just keep doing it. But now I'm leveraged. Let's fast forward 10, 15 years. I got 10, 15 houses. That's a lot of debt, right? It's a little scary for people and stuff like that. Should they be scared? Is that the right, I don't know. It seems like you're exposed a lot, right? So what if all of a sudden everybody stops making their payment, right?
They're like, what if everybody decides they want to start sleeping on the streets?
Sure.
Yeah, honestly, what's interesting about our market is
we become like a Detroit. You mentioned Detroit or something like that.
Yeah.
Sorry, keep going.
Yeah, so it all depends on your market and your risk tolerance, right? And I recommend, if you're in a market that's growing like ours, where you've got 20 years of, not only do you have a shortage of housing, right? We have a 200,000 unit shortage of housing in Utah. And then on top of that, we have 20 years of demand already here. And something very unique about Utah is because we're a very family-centric state, even if kids go away to college, they come back. And so that's something that's really unique about Utah. Not only is our population growth 5 times the national average, but kids aren't leaving the state. We are 3 years in a row being ranked the top economy in the nation. And so we're a state that creates jobs. So our graduates can find work here and high-paying jobs here. And so in order for real estate to be a risky investment in Utah, we would have to have a natural disaster that creates a mass exodus. And so we have a governor and we have a legislature that is very pro-business. I think we're 14 years in a row being the #1 state to start a business and own a business. We have more entrepreneurs per capita than any other state. We create jobs. We believe that creating a job is better than getting a job. And that's part of our culture and who we are.
And so your point with all that is that, hey, there's going to always be demand here, is what you're trying to say, right?
We have pent-up demand. Literally, we would need a massive natural disaster, and maybe a controversial topic, maybe not so controversial anymore. I feel like everyone on both sides of the aisle recognizes that climate change is a thing, regardless of what might be causing it, right? We're seeing an uptick in natural disasters. Utah is considered a climate change safe haven. So we don't have major natural disasters here. Flooding, washing away houses like in California, not an issue here. Major earthquakes, we do have some earthquakes, but it's not like California. We don't have hurricanes like in Texas or Florida or the Panhandle states. We don't have tornadoes like the Midwest. And so when it comes to natural disasters that could cause a mass exodus, we actually have more people coming here. And it's interesting too, like people say, we have a water problem in Utah. We sell water to Nevada, and currently only about 30% of our current water usage is actually by households. 70% of our water usage is agriculture, and a lot of that is growing alfalfa that we export to China. And most voters don't know that, but I'd say in Utah, a lot of voters, if they did know that, wouldn't be very happy about it. So if there was ever a time that turning on the tap resulted in slow water flow because we were running out of water. There are so many levers that we can pull. Our population could easily triple in Utah and water would still not be an issue. And yes, we're the second driest state, but here along the Wasatch Front, we've got lots of water. And anything else, natural disaster related, we're a safe haven. And so we have the population growth. We have all of the kids that are going to be aging in to the population where they move out of home. And especially when it comes to our strategy with new construction townhomes, as real estate gets more expensive, the younger generation is renting longer and longer. And so people no longer want to stay in apartment complexes. They don't want to be walking up 3 flights of stairs. They don't want to be clearing snow off their car in the winter and carrying their groceries in the rain. I'd say it's a bad time to own apartment complexes in Utah, but it's a great time to be investing in townhomes because as the younger generation is acknowledging that they're going to be renting longer than they think, they don't want to stay in a tiny apartment. They want to be at least in a townhome. And demand is on the increase for quality rentals that provide the quality of life that people are looking for in our state.
Tell us a little bit more. You mentioned to take advantage of some of the strategies we need to manage these properties ourselves. Tell us a little bit about how you would help an investor set that up and be comfortable with managing themselves.
Yeah, so before talking about how we help people self-manage their properties and make it easy for them to take away the headaches of being a property manager, I think our viewers need to understand a little bit about why they have to self-manage their properties. I've met so many people that are doing this strategy illegally, so to speak. So they've bought properties, they're doing cost seg studies, they're taking the tax savings against their regular income, and they're paying a property manager. And they've gotten lucky, they just haven't gotten audited. However, the IRS says that collecting a rent check, if you're using a property manager, is considered passive income. So the accelerated depreciation, that's a paper loss on the property losing value. And so that loss is also considered passive. Your income at your W-2 job or from the business that you own, that's active income. And so the only way to offset the taxes on your active income is to have an active loss, like buying supplies for your office that you use up over the year, right? That's an active loss. It's something that money you lose on as a cost of doing business, your active business. Whereas if you're collecting a rent check and you have a property manager, that's a passive loss. It's stuck with your rental property. You can't use those losses to pay less taxes on your regular income. And so there's 2 ways around that. One is to own enough rental properties and have a stay-at-home spouse that self-manages them for you. So the IRS says in order for those losses to be considered active, you have to work at least 15 hours a week. So it's 750 hours. If you take 2 weeks off your vacation, you have to work 15 hours a week in real estate for your activities to be considered active. And the term for that is a real estate professional. You don't need a real estate license. You could be an electrician or a plumber or a framer that works on new construction homes. You count as a real estate professional. As long as 500 hours of your 2,000 hours a year of work are in a business that you have at least 5% ownership in. And so if you're a business owner that has a stay-at-home spouse and you own at least 3 rental properties that your spouse self-manages, you can easily qualify as a real estate professional. So now that accelerated depreciation on your properties, you can use to offset your regular tax bill. So I mentioned earlier, I think before we started recording, that my broker has been in real estate for 50 years and he learned about this strategy 15 years ago. And since then, he hasn't paid taxes and none of his investor clients have paid taxes. And that's because either they're in real estate, that's their business, and so they're a real estate professional, or their spouses who are stay-at-home self-manage their real estate portfolio. And so they qualify as real estate professionals. They don't have a real estate license. They're not managing other people's properties. They're just self-managing their own properties. And so now back to your question. A lot of people who've met people that have rental properties or these old aging properties that are a big headache. I don't want to deal with phone calls in the middle of the night that there's a clogged toilet. Right? That's an example a lot of people use. Sure. I don't want to be woke up in the middle of the night from a tenant complaining about a clogged toilet. And that's what's so great about new construction townhomes is they come with a warranty. Most builders in Utah provide a 10-year warranty on new construction. Even if a builder doesn't want to provide a 10-year warranty, by law, there's an implied warranty on new construction for the first owner of at least 6 years. And so not only is it less likely for you to get calls from your tenant because something's not working, but we also have systems. So technology has made huge leaps, especially with AI. And so we have a free software that we teach our clients how to use where it's a few clicks of answering some questions from a drop-down to create their lease and send it off to their tenant for DocuSign. And rent collection, you set it up once and it collects their rent for them every month. If their tenant's late on their rent, they get warnings automatically. And once they've passed whatever grace period you put in the lease, it automatically charges them the late fees. And so instead of charging like a one-time, in Utah, you're allowed to charge a late fee of up to 10% of the rent. And people will make a mistake and they'll just say if they're 5 days late, we're going to charge them a 10%, like the maximum late fee. Not only does that cause resentment with your tenants, but also day 6, I owe an extra $150 or $200. I guess I'll just wait. There's no incentive to pay it before the end of the month.
Sure.
And we recommend breaking it up into a more manageable $25, $30 late fee per day. So they get a warning, your rent's due. They get every day they're late during your grace period, they get automated emails and texts. You need to pay your rent. And as soon as they hit the next day after that grace period, it automatically charges them a late fee. And it reminds them that you'll be charged this again tomorrow if you don't pay today. And so using systems like that, like once you have a lot of properties, it's really hard to keep track of them all. If you listen to podcasts on like Bigger Pockets podcast, like the hosts of that show will talk about, I had a property where I hadn't collected rent in 8 months and I just didn't realize it because I wasn't using systems. And so there's no school to go to teach you how to be a property manager. And so we provide that for our clients. We're real estate agents. We make our money off of the transaction. So you don't pay us. The builder who's selling the new construction townhomes, they pay us. But the value that we provide is the services after you close on the property. We have systems that we allow you to utilize to help it make it easy to find tenants. We provide you the software to help you create your leases, collect your rent, automatically charge late fees if they're necessary. And then we have partnerships that we have that you can pay $25 a month and get 4 visits to your property a year from a maintenance company that comes and tunes up your AC in the spring before it gets hot so you don't get tenant calls that the AC stopped working. They come out in the fall and they tune up your furnace to make sure that your tenant doesn't call and say the heat's not working in the middle of winter. What's interesting is when an AC goes out or a furnace goes out, it's always when it's the hottest or the coldest. Sure. Because it puts the most stress on those systems. And so if you do preventative maintenance, those systems are going to last at least 15 years before you have to worry about a major repair or replacement. But if you don't do the annual maintenance, you can counter that in 5 years. And so the preventive maintenance piece, it's a very low cost, but it saves so much headache, and you don't even have to schedule it. Like our partnerships, like you give them the name and number of your tenant and they call and schedule with your tenant. You don't have to be involved. So it's systems like that make it so much easier to be a property manager. You're in it for building generational wealth. You're in it for the tax savings. You don't want a second job, and even a stay-at-home spouse, managing a household is a full-time job, and raising kids is a full-time job. So most stay-at-home spouses already have 2 full-time jobs. They don't want a third job. Yeah. You don't want a second job if you're the breadwinner, and they don't want a third job. And so making it easy to be a landlord is really what sets us apart.
What about, obviously, one of the things that takes up my time the most is when a new tenant or a tenant leaves, and then you got a new tenant. And so that's often when me personally, I would self-manage, and then I'd get busy with doing loans. And that's when, like, it would be often in the summer or something like that, they move out, and I'm like, okay, I don't have time to go show this house. I don't. And it's worth it to me to pay somebody to just manage it, because I can make far more money at my main job, right? Whatever that is for anybody that's listening. Do you have a part for that part too then?
Yeah, so I have 5 agents on my team, and 2 of them specialize in first-time home buyers. And so we provide free tenant placement services for our clients because it's a free lead source for the agents on my team that specialize in helping first-time home buyers. And so you don't want some of the best tenants with the highest credit scores and the highest income. A lot of them, they're only looking to rent for another year or 2 while they save up a down payment. And so something that we do when we help you place tenants is we make sure that all of them know if they qualify to buy now, that we make sure they know. And so by doing those home tours, the agents on my team that do the home tours for you when you're placing a tenant either right after you buy or if you have tenant turnover, we help with that. And so we intercept the people that are only going to rent from you for a year or 2 because tenant turnover is expensive. So we have partnerships with both a professional cleaning company and a professional handyman company that specialize in tenant turnover. And so with just a week's notice, they will come out within 7 days of you calling them. And most of the time, more than 7 days, right? Most leases, like the software we use, start sending you reminders. Your tenant's lease is up in 6 months. Your tenant's lease is up in 90 days. Your tenant's lease is up in 60 days, right? It sends you reminders that ask them if they're going to renew. And if not, call us and we will help you find a new tenant, get them lined up for when they're out. And so within 7 days of your tenant vacating, the handyman company will come out and tighten up any doorknobs, tighten up the cabinets, fix any issues with the drywall, paint, and then the cleaning company comes in and does a deep cleaning. So even if you don't allow smoking or vaping or pets, it's not uncommon for tenants to lie about those things. And if someone had a pet that they didn't tell you about, or let's say they had a service animal, because you can't not rent to someone that has a service animal, professional cleaning, deep cleaning, removes the pet dander to make it safe for your next tenant. If they have an allergy, they're not going to come in and do a tour and start sneezing, right? And so deep cleaning, it keeps really the difference a lot of times. Like, you might think you need to replace your carpet, but getting a professional deep clean brings new life to it. And so we have those partnerships to make it easy for you, and we help you place new tenants, because showing a property, you can find the members of my team, they can find people that are ready to buy now. And totally off topic of what we're talking about, but something great about Utah, the governor wants to keep our highly educated young people in the state. He doesn't want to lose our talent. And he knows that really the only thing that would chase someone away is the high cost of housing. And so we have a program here in the state of Utah that will provide $20,000 for first-time home buyers if they buy new construction under $450,000. And so our relationships with builders for our investor clients gets us special incentives and pricing for first-time buyers as well. So we leverage those combined with the $20,000 from the state. That means that the average couple that can afford to rent a brand new construction townhome, they make enough money to afford a down payment, to afford a monthly payment using that $20,000. So if someone doesn't have any money saved to go towards a house, that's always what people say. We need a year or two to save up enough down payment. We want to own, but we just need to save up for a year or two. We remove that obstacle. So we intercept those potential tenants that will only be there for a year or two to save you the cost of tenant turnover, deep cleaning, and having a handyman in to tighten things up and make sure everything looks new. So yeah, that's how we make it easy for you. So we know that the pains of being a landlord are a big reason why people who need the tax savings stop buying properties, because they can't handle more. So we've created systems and we have partnerships to make it easy for you to grow your real estate portfolio as large as you would like.
So it sounds like you're so a lot of it just seems a la carte almost. So I'm technically still managing it, but I can farm out this and this so I don't have to do it. Right. And so I'm paying per thing,
Yep.
as opposed to saying, hey, you just handle it. I don't even look at this. So I'm still involved in manage. So you can check that box for the tax part, right? So you can say, hey, I'm managing it myself. But at the end of the day, if I really don't want to manage it myself, I can say you do this. Is that fair to say?
So essentially what you're doing is exactly what property managers do. So a halfway decent property manager is managing 300 to 400 properties. Yeah. Good property managers are managing over 1,000 properties. How is that possible? They use these same systems.
And so you're just giving those then to the average Joe guy, I guess,
yeah,
right?
Honestly, like there are some great property managers out there that offer a lot of value, especially if it's an old aging property. When it comes to if you're buying new construction and following this, paying someone 10% to do basically nothing is a huge waste. It does not make sense to pay for a property manager for a new construction property. But there are still things that need to be done. And so property managers love it when someone comes to them and says, will you manage my new construction property? They're like, oh man, this is great, free money.
Sure.
And so all we do is we share with our clients the systems that property managers use to allow them to manage so many properties. And so they're real estate professionals because they're property managers. Your spouse is a real estate professional because they're self-managing their own properties. You're fielding phone calls, you're fielding inquiries from tenants, but someone has to call out your plumber or your electrician when something goes wrong. There's still work that you're doing, but we're talking about a 15-hour-a-week part-time job versus a full-time 40-hour-a-week job. There's plenty of clients that I have. I have a client right now. We're closing in a week or so on 12 new construction townhomes. They had 8 doors across 3 properties of old aging multifamily. And they're like, we have the money, we want to buy more real estate, but The spouse that was the stay-at-home parent, that was the real estate professional, she has 4 kids that she raises. And this has become a full-time job. And I only have 8 doors across 3 properties. We want to buy more real estate. We've got the money sitting in the bank, but we can't handle more. Yeah. And so when they learned about the strategy that we do in the systems, they had 8 doors. They weren't using software to collect payments. They were collecting rent checks. They were calling them when they had late payments. They weren't doing preventative maintenance. They were putting out fires instead of having a system where you don't have to worry about it and it's automatically taken care of for you. And so now they're growing their portfolio again. They're getting rid of those aging properties and they're trading them in for new construction townhomes and utilizing these systems to make it easy so that with 4 kids, she can manage 15 hours during nap times or after the kids after bedtime. She can't do more.
If somebody uses every widget, everything in a system you have and stuff like that, compare it to cost of, if I hire a property management company at 10%, how does your system that's self-managed, how does that compare? From a cost perspective. If I use it all, everything you use
all the systems,
medicine,
it's less than $100. Everything costs less than $100 a month. New construction townhomes, you're going to be averaging anywhere from $2,000 to $2,400 a month in rent. And so in traditional property management, most property managers, they have 3 tiers. They have their 8% tier, their 10% tier, and their 12% tier. If you want them to actually take care of everything, you're paying 12% plus at least 50% of your first month's rent to utilize their services. If you're using the preventative maintenance plan, you're using our partner that comes and if you've got a water softener and they're coming and refilling the salt and taking care of that for you and changing out your air filters for you, you're looking at less than $100 per unit. Versus if you were paying 10% to a property manager, you're paying anywhere from $200 to $240 a month plus half of your first month's rent, or sometimes your entire first month's rent. And it's massive savings using all the systems. But also the biggest savings is you can legally claim the tax savings. And if you're a successful business owner that has income in the highest tax bracket, buying a townhome is going to get you over $100,000 deduction the year you buy the property. That's going to save you $30,000 to $40,000 off your tax bill. And so what we aim to do is to help you leverage as much as possible so that you're really building your wealth in the equity. So our goal is to help you just break even on the property. You put the least amount of money down, you break even on the property, and you're building long-term wealth. You're doubling your portfolio every 7 years. You're generating additional tax savings every 7 years and keeping it as easy as possible. So yeah, even if someone pays to outsource everything they can and use systems, it still saves them a ton of money.
Let's say that someone has done this every 7 years, sell and buy more, and now they've done that 4 or 5 times, they're getting ready to retire. What strategy, is there an exit strategy, or what do you suggest they do as they're getting ready to rely on this income for retirement?
That's a great question. One of the benefits of working with us is we help you grow your portfolio. We're very aware of how many properties you have, how long you've owned them, doing CMAs to see where the equity's at in the property, to know when it's time to either do, because let's say we experience another pandemic and you get a ton of equity and you've only owned the property 3 or 4 years, right? You don't need to sell the property yet because it's still a great property. We can help you know when it's time with our lending partners to do a cash out refi. Let's say you're up to 10 properties and you're like, we've had a couple really good years in real estate. We're sitting on a lot of equity. If rates are comparable to what you currently have, some of our lending partners, they hold their own loans, so they do free cash out refis. And so it's none of your properties has enough equity to do a cash out refi to buy a second property, but you have enough equity across every 3 of your properties. And so you might do cash out refis on all your properties because it's free with your lender that's holding your loans, and you're able to pick up 3 more properties. Those are things that our team can keep track of for you to make it easy, but also retirement planning. So you do not want to be hit with any recapture taxes if you sell a property before you would have earned the appreciation that you accelerated. And you also don't want to be hit with 20% capital gains taxes when you sell your properties. And so as we're doubling, we're doing 1031 exchanges, and we have a partner that does those for free. They realize that you letting them hold on to your cash for 6 months is an interest-free loan for them. And if you actually have over $1 million parked with them, they'll actually share 1% of the interest they're earning on your money with you. And so it's a really cool model. But when it comes to retirement, what we do is we start consolidating your rentals. So instead of doing a cash out refi to buy another property, we start doing cash out refis of your best performing properties to pay off the debt on your oldest properties. And so once you've paid off the debt, we then will sell it and 1031 it into syndicated real estate. syndicated commercial real estate that have triple net leases. And the colloquial term for this is a TIC, stands for tenancy in common. But essentially, think about Home Depot, Walmart, Burger King, Taco Bell. None of these companies own their real estate. A lot of people don't know that. So these buildings, you know when you see a Taco Bell or a Burger King or a Walmart or a Home Depot, right? Like the colors, the way it's built, like you know what that business is from the architecture. But those buildings are built to suit, and they come with a 10-year lease guaranteed by the parent company. And there are builders that they have these relationships with these blue chip companies, major franchises. And when they're ready to open a new location, they contact them, and they have to come up with the capital to build these buildings. They source that capital from private investors. And a lot of these guys, they have enough capital where they build the building, and then they have a company that specializes in syndicating real estate that they sell the shares in that property. And that is eligible for a 1031 exchange. And when we know, hey, like I've hit my max of properties, I don't want to be buying anymore, that's when we start, every time we have enough equity, we start doing cash out refis of the newest properties to pay off the oldest properties or the underperforming properties. And as soon as it's paid off, we can 1031 it into syndicated real estate. And let's say that Taco Bell location or that Tractor Supply location isn't successful and goes under. Your client is guaranteed rent payments that go up 3% a year for the full 10 years of the lease. It's backed by the parent company. And it's called a triple net lease because the tenant's responsible for property taxes, insurance, all maintenance, and all repairs. And the cost of that is zero. And you're earning anywhere from 5 to 7% return on your investment in rent checks every month. And contractually goes up by 2 to 3% every year to keep up with inflation. And if that location goes under, you're guaranteed rent checks for the next 10 years. And so it's a very low risk. There's no leverage there. And so that is the exit strategy.
But why do that instead of just keeping it in residential real estate?
So it's managing, right? So if you want to, you could say, I've got my tax savings, I'm going to hire a property manager. But most people, when they're going into retirement, like they just don't want to stress about it. They don't want to worry about repairs. They're done. They don't want more doors. They want, well, my one client calls mailbox money. They don't want to think about it. They just want to get a check in the mail because they're retired.
Okay. And I guess the alternative would be having somebody manage it, the normal way kind of thing, but you don't necessarily recommend that then.
Just as properties age, right? Yeah. If somebody really wants to, you can hold, I would still say, don't hold any properties past 10 years. Once the builder warranties run out and you might start having expensive repairs, trade in the property for new property. If someone's, I want to keep paying down the mortgage and cash flow from them, I still recommend refreshing your portfolio every 7 years so that you're always in new properties. Plus, new properties appreciate faster. If you buy something in an established neighborhood, you're already paying top price for that land. Whereas where builders are buying affordable land and the first thing that goes in is housing. And then the businesses come in to follow where this new unserved client base is. And so the appreciation in the path of progress is a lot faster than an established neighborhood. So the average over the last 40 years is 5% appreciation for real estate in Utah, but there are areas that outperform and underperform. Established neighborhoods are a lot more expensive to get into, and the appreciation is a lot slower. It basically is inflation, whereas buying in the path of progress, outsized appreciation. You get in for less money, and it appreciates faster. And so once that area is established, it slows down. So you really don't want to be holding a property for a long time, not just because of the age of the property, but also your appreciation slows down. Okay. So yeah, you can keep your money in residential real estate, and as you start to cash flow more on the property, that's your cash flow.
But your main argument is always, hey, continue to churn those things. Just from a tax perspective, from a maintenance perspective, that's,
to
kind
keep
of
your
maximizing things.
And my broker, he is a real estate professional because he manages a brokerage of over 40 agents. He qualifies as a real estate professional. And so he is involved. He gets plenty of hours managing his property managers of almost 300 properties. But he hires a property manager that he pays a salary to. So he's not paying 10% of his rents to a property manager. He's gotten to the point where he's approaching retirement. Sure. He doesn't want to do it himself. His wife doesn't want to do it. So they've started hiring people to manage their properties. And it saves him money, and he doesn't have to stress about it. I'd recommend doing something like that if people want to hold on to their properties in retirement versus hiring a company that's spending all their time finding new clients and not actually managing your properties the right way.
You've given people a lot of things to think about here. If you were to dumb it down on kind of a 60-second kind of thing, if I'm 23, starting off and stuff like that, what's my 40-year plan here? Just boil it down in 60 seconds kind of thing of what that would be.
Yeah, so if you're in your 20s and you don't own any real estate yet, if you've got a full-time job, likely you can afford, if you can afford to rent, you can afford to buy, especially with the Utah housing program that'll give you $20,000. Get into your first house. 7 years from now, you're likely going to have enough equity that you can buy the primary residence single family home that you want and either turn that townhome into a rental or trade it out for a new one. And once you start, if you have 30 years till retirement, you can build $1 million a year in passive income over 30 years, starting with one property.
And so how would they do that then? So because a lot of times that first home, they're barely maybe zero down, right? You mentioned 20,000 from Utah Housing or something. So they do that. Then that next house, where they're like, hey, I want to keep it as a rental, but there's 50 grand there. I need to take that 50 grand and put it into this new house. So you're not saying that's not a bad idea. You're saying do that still? Or what would like?
So one of the benefits, there's a whole strategy for young people that want to invest in real estate. So I have a friend, he's made his poor wife move 7 years in a row. So they bought their first townhome with 3.5% down, the required for an FHA loan.
Yep.
But you can only have one FHA loan at a time. And so they bought a property to be able to only have to put 3.5% down.
Yeah.
And so that's on a townhome, you're talking like $15,000. And most builders will pay your closing costs for you. So basically every year over the last 7 years, his goal was to save $15,000. So he bought his first house. He lived there for a year to qualify for 3.5% down payment. And then he turned that property into a rental. So it all depends. You can only have one FHA at a time. So he has enough equity that he can now refi, right? You can get a conventional loan with, some banks are doing 3% down or 5% down to get a conventional loan. So refi the first property, pull out some equity if he needs it, but his goal would be to save enough to do an FHA loan on his next house. And so that's what he did. So he saved $15,000 a year, and every year he bought a new property with an FHA loan and turned his last property doing a cash out refi to a different type of loan so that he could keep it as a rental property. And now he has 7 properties. Following this strategy, he doesn't need to invest another penny in real estate. If he just, every 7 to 8 years, he doubles his portfolio, he's going to retire with several $1 million a year in passive income from the wealth that he's going to build. That is generational wealth. He's not even 30 yet. He started that in his early 20s.
And I just to help everybody understand. So the reason he's doing that a year at a time is because one of the requirements is they have to live in the home for a year.
Yeah.
And so he's living there, satisfying the requirement, and then he jumps to the next house and does that repeatedly. And so
because investment loans, if you're getting an investment loan to buy a house, you're putting 20% down, and that's a lot of money. 3.5% is a lot less money.
Yeah.
And so you can get that with an FHA loan as long as it's a primary residence, and you have to certify that it's going to be a primary residence. You're not going to rent it out, and you're going to live there for at least 12 months. And so he's using the benefits of a primary mortgage on a primary residence to get in with very little money. And so you can use, if you don't have any money saved and you want to start getting in real estate, you don't own a home yet, use down payment assistance program from the state. They'll pay your down payment. You'll probably have to live there a few years because when you sell that house or refinance, you have to pay that $20,000 back. It's a zero interest, zero payment loan. And you only repay the full amount if you net at least $40,000 profit from the sale of your home. And so you buy your house, you don't have any money. If you have an income, you work full time and you make at least $60,000 combined between you and your spouse, you can qualify to pretty much to buy a townhome in Utah County. So you buy your house, you live there I'd say you probably need to live there 4 or 5 years to build up an equity that you can pay back Utah housing when you refinance and still have enough equity that you can have your 3.5% down payment on your second house and have enough equity to qualify for a conventional loan on that property. So you do the refi while it's still your primary residence, and then you freed up and now you can do another FHA loan on your second home. So that's a strategy a lot of young people do when they
kind of the no cash, hey, I don't have a lot of cash strategy, right? Because again, it's hard for people to save up $20, $30, $40, $50,000, right? So I guess, two different strategies. Hey, I don't have a lot of money, but I can do this over time. The requirement is I have to move every now and then. The other strategy is, hey, I do actually have a lot of cash. I have a high paying job. Instead of putting $50,000 in the stock market, put it into real estate and do it that way. That's kind of two paths depending on your
and essentially the government's going to pay So if you're making over $100,000, say you have a good paying job and you're making over $100,000, you're in the 24% tax bracket if you're single. If you're married and you're making close to $200,000, you're paying at least 24% federal income taxes. And so that you buy a property, it's going to wipe out taxes on $100,000 of income. And so that's saving you $24,000. So if you're in one of the lower tax brackets, that $100,000 down payment, 24 of that is coming from your federal tax return because you're implementing this strategy. And it really snowballs.
Sure.
Once you start this strategy and you start implementing the tax saving strategy, it becomes easier and easier to buy each additional property.
Because you're saving all that money.
On
And
taxes.
again, it's different than, because normally if somebody has it managed, it's passive income, and that, let's say it's $100,000 still that I get to write off, but I can't write it off of my active income.
Nope.
And so-
Unless there's two strategies. So we've talked about the real estate professional status.
Sure.
As long as you're managing at least, in order to get 15 hours a week, you really have to have at least 3 properties. If you try to claim this and you have less than 3 properties, the IRS is going to say, isn't it reasonable and necessary for you to work 15 hours a week with 1 property?
Sure. Are you really needing that?
Do you really need that, right? And so if you own less than 3 properties, even if you have a stay-at-home spouse, they're not going to get enough hours. Even if they're not using any of the systems, it's still difficult to get enough hours to meet that requirement. And so if you're just starting, you don't have 3 properties yet. Or let's say you and your spouse both work. You're a dual income household. You don't have anyone to be a real estate professional because you both work full-time. There is another option. And it's really made possible because of the One Big Beautiful Bill. So I had 8 of my investor clients that are dual income households this last year that did what people refer to online as the short-term rental loophole. It's not a loophole. It's legal. It's allowed. But the IRS says that a long-term rental is not an activity that allows you to claim your depreciation against your active income unless you can get 15 hours a week, and that's 51% of all your working hours. But if both spouses work, you still have the option to buy a property and use it as a short-term rental. So I had 8 clients last year that we lined up a new construction townhome that they could close on in November. I have a staging partner that allows their furniture to be used in a short-term rental. So they came and helped set it up so they didn't have to spend $40,000 on furniture to furnish a short-term rental. So we bought an ideal long-term rental in a community, brand new construction townhome community that doesn't allow short-term rentals, but the city allows them and the builder doesn't care. And we bought the property, we set up a short-term rental, and they rented it out as a short-term rental the month of December, which there's a lot of people wanting to book short-term rentals when they're visiting family, especially in Utah. And so they book at least 2 stays of less than 7 days, and they work at least 100 hours combined between them and their spouse. And I have a packet with all the stuff you need to do to set up a short-term rental. It's pretty much impossible not to get 100 hours between you and your spouse. And then while they're doing that, we help them line up a long-term tenant for January. And so the year they buy it, they use it as a short-term rental. They log at least 100 hours of work between both of them, and that has to be more hours than the staging company or any cleaning ladies might get if they're cleaning between your tenants' stay. And then come January, we convert it into a long-term rental. They're able to claim the accelerated depreciation the year they bought their property. And then come January, we convert it into a long-term rental. And if they want to pay a property manager, they can, because they've already gotten the tax savings. And so that strategy means that you're going to have to come up, you and your spouse together are each going to have to work 50 hours to get your hours during the holidays, which is a busy time. But also, if you work in corporate America, not much productive happens in corporate America between Thanksgiving and New Year's. And so it's a strategy that works out for people. I feel like there's a lot more hoops to jump through, and it's a little more expensive in the upfront to do that. But it's definitely a worthwhile strategy that we do help our clients do if they're unable to qualify for the real estate professional status, either due to both spouses working or they don't have the money to get up to 3 properties. So they might do the short-term rental strategy, buying a property a year or buying a property every 2 years, every 3 years. But once they get up to 3 properties, if they have a stay-at-home spouse, they can switch over to the real estate professional strategy.
That makes sense. This has been good. This has been very good. I appreciate you sharing all this information. I think sometimes people can get a little overwhelmed with some of these things.
Oh, it's a lot.
There's a lot.
It's a lot,
And,
yeah.
and I guess what you're trying to show probably with this is that obviously the benefit of working with people that do have systems in place, that do have that knowledge of tax law, because obviously taxes are a big part of why you're saying this is a good idea for people.
I have to teach people's accountants.
Sure.
Yeah, like CPAs are generalists. If you were to print out the tax code in 12-point font on paper, it would be as tall as a 33-story building. It is impossible for a CPA, like most CPAs are generalists.
Sure.
Like they don't specialize in these things. And like we will work with your CPA to help them learn how to apply this strategy in their business. And we love CPAs. We have 8 partnership with CPAs already that we provide this service for their clients. And so their clients were asking about this strategy because since the big beautiful bill, they see stuff on social media,
Sure.
like how to pay less in taxes.
Yeah.
But their CPA tells them like, no, you don't qualify for this strategy. You're not a real estate professional. So we help people qualify. So CPAs love us because we help their clients qualify. We help them do the documentation that they need if they ever were to get audited, that they, not only do they qualify, but they have the paperwork to pass an audit if they were to get audited. So CPAs love us. Yeah, you don't need to switch CPAs to do this strategy. Like we'll help your CPA. And we have partnerships that do the cost seg study that they'll also, it's a CPA run company. And so they also will support your CPA in applying this strategy.
And so if somebody wants to get a hold of you guys, tell us again the best way to do that. Tell the name of the company again.
Yeah, so our brokerage is Mountain Land Realty, and our personal team is Real Estate Help Utah. So you need help with real estate help here in Utah. We can help people in other states, but honestly, we prefer to focus on Utah.
Sure. You become specialists in this area.
Yeah, we are specialists in new construction, townhomes under $450,000 that are ideal for first-time buyers and investors that want headache-free rental properties. And yeah, I can provide you my contact info. You can put it in the description,
show notes and
in the
stuff,
video. Yeah. But yeah, we'd love if people are interested in using this strategy. We'll hold your hand every step of the way and reach out to us, and we'd be happy to help you.
Okay. Thank you. Thank you, both of you, for coming on and talking to us. I don't think we have any other questions. Do you have any things you're dying to know?
No. Anything that we didn't cover that you'd like to throw in?
I've monopolized this entire thing, so I don't
all
know.
good.
It's got it.
Good. No, that's great.
Scott,
Yeah. Excited to help you guys out, hopefully.
Good. Okay. Thank you. Appreciate you coming on, and it sounds like you guys are doing good work here, so that's good. Good. Again, experts are important. I'm a big believer in, hey, we're not meant to do this life alone. We need each other, because I get really good at what I do, and I can't really get good at everything. You mentioned accountants and stuff like that. Yeah, a lot of us are generalists, or we're specialists in one thing, but then we have general knowledge of other things and stuff. But I think that's the benefit of people like you that do specialize in that, and so it's okay, no, I know what I'm doing here.
Yep.
And we can save you some money. So anyhow, thank you. Appreciate you guys coming on, and best of luck.
Thank you so much.
you.
Appreciate your time.
Thanks for tuning in to From Rents to Roots. I hope today's episode gave you insight, confidence, and maybe even a little inspiration on your homeownership journey. If you enjoyed this episode, make sure to subscribe, leave a review, and share it with someone who might find it helpful. And if you're ready to take the next step in buying a home, or just have questions, reach out to me or my team at Work Hard Mortgage. We'd love to help you on your path to homeownership. Until next time, keep working hard, keep building your future, and we'll see you soon.